In recent years, a very popular solution for a like-kind exchange has become a Delaware Statutory Trust, or a DST. A DST is a wrapper that allows investors to pool their capital together to invest into institutional quality real estate. Simply put, it allows investors to exchange up into a higher quality institutional property and exchange out of the day-to-day management. There's a full revenue ruling on this, 2004-86, that says an interest in a DST will qualify as like-kind for the purposes of an exchange. A good example would be maybe a $100 million apartment building in Dallas, Texas. And let's just say, for example, you're selling a rental home in Chicago for $1 million. You would sell that property through the normal process. You would roll the proceeds directly to a qualified intermediary. You'd have 45 days to identify a replacement property. You would simply identify the DST. And then the qualified intermediary would fund those proceeds with the Delaware Statutory Trust. Now, instead of owning a $1 million property in Chicago, you own 1% of this $100 million apartment building in Dallas, Texas. So it alleviates a few problems for you. Number one, you've paid no taxes on the sale. It's 100% tax deferral if done correctly. And number two, you've moved from an active manager of real estate into passive. There's also a lot of rules that you have to follow, including the 45-day identification window, 180 days to complete the exchange. You have to match debt and match equity, and it's very difficult to do a 1031 exchange on your own. You could think of a DST as sort of a turnkey solution where you can roll the proceeds very simply and quickly into a passive investment. The DST market is rife with fees. And not only are these fees high, they're also hidden. So unless you are going to read through the 200-page PPM, you may be unaware of some of these fees that are charged. The fees on the front-end load can be as high as 10 to 15%. There could be a managing broker-dealer fee, sales commissions, organizational and offering expenses, disposition fees, finance coordination fees, and they all add up over time. At Origin, we wanted to be very clear about our upfront fees, and we wanted to offer a better investment to our investors. And so, right on the front page, we show our acquisition fee and a reimbursement for organizational and offering expenses. It puts our front-end load in the 2 to 3% range, where the market rate for DSTs is anywhere from 10 to 15%. And we think that's going to lead to better investor outcomes. At Origin, we focus 100% on Class A multifamily in high-growth markets. That means we don't invest in shopping centers, we don't invest in office buildings or distribution centers. Multifamily has shown the highest risk-adjusted return of any of the commercial real estate assets going back the last 2 decades. It's consumption-based. Multifamily is a need, it's not a want, and we are severely underhoused in this country. We're very bullish for many reasons on the future of multifamily at Origin.